So equity funding is really the risk capital in project financing, and it forms a margin of safety required by the debt providers. The equity investors are primarily the sponsors, and equity sponsors or providers may include original project developers and other parties who will benefit from the project, such as key suppliers or purchasers of the project's output. Now, prospective equity investors will assess the benefits that are expected to be derived from the operation of the project, and the expected benefits to the equity investor must be commensurate with the project risks it has to bear. Otherwise, the equity investor's commitment to invest funds in the project won't be justified. Now, from a lender's point of view, the equity should be substantial, even if, on a strict analysis, high levels of equity are unnecessary. On a nominal basis, the equity levels should be quite substantial. Larger than necessary levels of equity mean that the debt service stresses tend to be lower, and that in turn means lower risk for the lenders. So the more equity there is in a project, the lower the risk for the lenders. And lenders are looking for reassurance that the sponsors are not going to walk away from the project in hard times. And if there's more equity, it gives them greater assurance in this regard. And it safeguards the lending that the bankers make to the investing company. Equity providers, remember, are last in priority for repayment. And in return for assuming this risk, the equity providers get much more upside on the potential of the project. They are the ones taking the equity risk on the project, and they've got much more potential for making greater profits on it.